Now, before we talk about the convexity of forward prices uh, and the linearity of future prices, I just want to tell you a little bit about the differences in forward prices and future prices. They are both actually identical if interest rates are not changing. So, if interest rates are constant, forward prices and future prices will be the same. And the other condition is that future prices are not correlated to interest rates. However, if there is a violation of these assumptions, which means either the interest rates are changing or the future prices are correlated to interest rates, then there will be differences in the forward and future prices. Now, the correlation between future prices and interest rates can be positive or negative. If it is positive, which means when interest rates go up, the future prices go up. If that is the situation, now just hold on here and think about it, that you've got some money invested in a future contract, right? And interest rates are going up. Now, this is a good situation because if the future price also goes up, then you can sell your position, right? And you can take your money and you can invest it at the higher interest rate. So, when future prices are positively correlated with interest rates, people like to invest in long future contracts as opposed to going long the forward contracts, because the future prices are positively correlated with interest rate, whereas forward contracts prices are not. So when this happens, they would rather be in a future contract so that in case interest rates do go up, they can easily sell their profitable position and invest the money at a higher interest rates, right? And this is what it says over here. This is because rising prices will lead to profits. Rising prices of the future contract will lead to profits that can be reinvested at the higher interest rate. So reinvested in periods of rising interest rates. And falling prices will lead to losses in periods of falling interest rates. So naturally you don't need to take your money out and reinvest at a lower interest rate. So then you can just hold your loss. But the more important point over here is that if it goes up, then your price will go up. You can book your profit and invest the money from the contract and the profit into a higher interest rate. Now, if the opposite situation is true, if you have a negative correlation between interest rates and future prices, then naturally, obviously, people will want to go for forwards as opposed to going for futures. So they will then want to go for forward. Now, whichever situation is more desirable, let's say if situation A is there and futures are more desirable, then futures will have higher prices, right? Or if situation B is there where they are negatively correlated, then forwards will have a higher price. And how much higher will the price of a forward or a future be depends on the volatility of interest rates. Now I would like to tell you how interest rates impact these two different prices, which is forward and futures. And I'll show this with an infographic as I promised in the previous video, that this concept is easily understood with an infographic. And first I'll start with the futures. And if you remember the example where I told you that the interest rate went up 1 basis point and it went down 1 basis point, and the profit and loss of the on the position was $25, whereas if it went up 1 basis point, there was a change in price of approximately $25 as well. So this is a what we call a linear relationship between the change in the interest rate and the price of the forward. And if you look at price of the future, and if you look at what is going on with the forward, it's not linear. It is non-linear, and rather it is a convex relationship. And why that is because the future is being settled on a day-to-day basis. But with the forward, what happens is, let's say the loan will start 1 year from now and then it is going to be for another year. So the settlement is done at this point, right? But we are, let's say, here when we know what the rate is, and we take the settlement and we discount it back to today. This is something which is done in forwards, but this is not done in futures. Futures are settled on a daily basis, whereas forwards are calculated at the end of the contract termination, and then they are discounted back to today at the start of the contract to calculate what will be the profit and loss, and it is settled at the start of the contract, assuming that the settlement will be done at the end of the contract, but it is discounted back to today and then it is settled at the discounting value. And this discounting feature, which is only there in the forward rate agreements and it is not there in the futures, this is what leads to this convexity bias, which is there in the forwards only, or the forward rate agreements only. Now let me demonstrate this with an example as well. So let's say we are going to look at an interest rate future of 1 million with a MRR of 2.2%, and we're also going to look at a forward rate agreement of the same notional amount, 1 million, with an identical rate of 2.21%. And we know the formulas for both the calculations, as we have seen in the previous videos, and we use those formulas to calculate the settlement amount for both. And as you can see over here, that this comes out, and we have calculated this before as well, that when it was going up 1 basis point, the contract was showing a basis point value of $25, right? And when we use this formula, which is for the forward rate agreement, so first we take the difference between the two rates of the forward rate agreement, which is the new rate and the old rate, and we take that difference and we multiply it with the notional principal. So the 1 basis point is the difference from 2.21 to 2.22. So this 1 basis point difference multiplied by the notional principal also gives us this $25 amount, which is the same as this, but the only difference is that this has to be discounted back to where we are now, because this $25 will be there at the end of the contract, but we are here now. So we need to discount it back, and that is what is happening over here, that they are taking this $25 and they are discounting it back to 24.86. And when you see how that looks on the chart, is that for the futures it is exact 25 multiplied by the notional amount. It is coming to 250 and 500 and 250 and 500 negative as it's going up and coming down. So here we are looking at not a 1 but a 10 basis point change. 10 basis point change. So instead of $25, we are seeing $250, because the change over here is not 1 basis point, it is 10 basis point. But if you look at what's happening with the FRA, it is not exactly 250, it is not exactly 500, it is a little bit less. It is a little bit less. Why this convexity is there is because of the discounting feature, which is actually making it little bit different, and that is what brings this convex relationship in the forward price, but it is not there in the future price. The future price is completely linear. Now, one last point, that after the 2008 financial crisis, what happened was that a lot of FRAs were there, forward rate agreements, a lot of swap agreements were there, and they were all over the counter. They were all forwards, so they were customized, they were private, they were not declared, they were not in futures exchanges. And when one of the big banks went down, they had a lot of exposure towards the other bank, and then the other bank went down, and then it was going to take the third bank down. But then the government stepped in and stopped the third bank from falling. But the point is that now, to stop this from happening again, what the government has done is that they have got something called central clearing going on, even for the over-the-counter derivatives, even for the future, even for the forwards. Now we have even for the over-the-counter derivatives, we have something which is similar to the futures, which is a central clearing, which means the dealers who are dealing in this, they have to post this margin, right? So either cash or maybe highly liquid securities, which are usually government bonds. And this kind of makes them like futures. So, I mean, even though forwards are forwards and they're not supposed to have futures like margin requirements, but now just for safety requirements, the government has got this central clearing requirement, and because of that, what happens is that whichever financial intermediary is dealing in all of this needs to post a margin with the central counterparty, and because they need to post the margin, then what they do is they ask their customers to actually post a margin with them. So they impose similar requirements on their end users. So now the swaps or the FRAs, they are becoming more similar to futures because of this central clearing counterparty requirement. And these margins have obviously reduced the difference in cash flow impact of exchange traded derivatives and over the counter derivatives. So exchange traded derivatives are your futures, right, which are settled on a daily basis, and they are what have a cash flow impact which is on a daily basis, whereas your over the counter are your forwards, and those even though don't usually have a daily cash flow or settlement, but because of this new central clearing requirement, they are becoming closer to the futures, and the cash margin requirements are making the differences between the two less and less. So let's look at the summary. The first learning outcome for this learning module is comparing the value and the price of forward and future contracts. This is a formula we know very well now, that you take the spot price and you load it up with the interest cost, the time value of money, and you get the future price. The only difference between what we have seen before is that we're dealing with a capital F, which was the forward price, and here we are dealing with the future price, but the formula is exactly the same. However, the difference is that for the forward contract, the gain or loss is realized at the end of the contract, whereas for a future contract, we have a daily cash flow for profit and loss, and on a daily basis the settlement is there, which resets the contract value to zero on a daily basis. And this process continues until the contract matures and the future price converges to the spot price. This is called the process of mark to market, and there is a gain or loss. Eventually, at the end of the day, the cumulative net mark to market will be the same, almost the same as the forward contract. So even the forward contract and the future contract, they come to the same profit or loss at the end of the contract. It is just that the future contract takes a different method of getting there with the daily changes and the daily mark to market, and the forward contract only makes the adjustment at the end of the term. But they do get to the same place, approximately almost the same place. The forward contract price also doesn't change. It remains fixed throughout the contract, but the future price obviously changes on a daily basis based on market changes. Now, the second learning outcome is why forward and future prices can be different. They shouldn't be different. They should be identical if interest rates are constant and future prices are not correlated to interest rates. However, if future prices are correlated, and if they are positively correlated, that means when interest rates will go up, your future prices will go up. Then obviously people would rather have long future contracts, because then if the future price will go up, they will book their profit and they will take their money and they will invest at the higher interest rate. However, if future prices are negatively correlated with interest rates, then people would rather be in long forward contracts instead of long futures contracts. And depending on the situation, whichever is the more desirable contract, that will have a higher price. And how much higher that price will be, it depends on the volatility of the interest rates. And interest rates do impact the price differences in the way that, because FRA is based on a discounting feature, where if you are starting a loan after 1 year and it is going to be another for another 1 year, then the settlement will be done at the end of the second year and you actually discount it back to today. And therefore, because of this discounting feature, you have a convexity bias in your FRAs, which is not there in your futures right, which is a completely linear relationship. But for the FRA, this discounting feature actually creates a convexity bias.